We've heard a lot about sector rotation in the second half of 2024, but even more rotation could be underway after next week's election. Let's dive in. Today, we have Jeffrey Bierman here to help walk investors through how to navigate potential rotations that could still be coming yet this year. Jeffrey is a finance professor at Loyola University Chicago and the chief market technician at TheoTrade. Jeff, we are so excited to have you here at Market Beat Media today.
I'm just as excited to be here. I've heard a lot of good things about Market Beat. So
Oh, good. We know you have plenty of knowledge to share with our viewers here today, too. We're going to share some of your picks and where you think sector rotation could be headed, no matter who wins the election. We'll share your stock picks in just a little bit. But first, let's start out with the basics. What exactly is sector rotation?
the general gist behind it is just this, is that there are 11 different sectors in the economy, or 11 different sectors that drive the S&P 500 index. Some carry more weight than the others. Nevertheless, the 11 sectors represent areas of the economy in the economic cycle. So for instance, you've got the economic cycle will peak, it will trough. On the way up, growth sectors tend to take off. So stocks like, financial stocks will take off, housing stocks will take off, Caterpillar, Deere cyclical stocks will take off. But as the economy starts to moderate, money will then shift from one sector to another sector based upon where you stand in the economy. So the idea is the sector rotation is a leading indicator that moves about one step ahead or 3 months ahead of the actual economy. So if you actually watch the market, Bridget, and you see money moving from, let's say, technology, and you're like, oh, it's going to oil, it's a signal that we're moving from one phase of the economy to another phase of the economy. But here's the thing, they don't always move in step the same time they used to do historically. There's been kind of a hiccup in between where some sectors will correlate, and all of a sudden it's like they're not supposed to correlate. And they do, and then they break apart. But sector rotation has primarily driven the market since about July.
Yeah, did we see any kind of sector rotation come into play with the Fed rate cuts that we saw earlier this fall, too?
We actually did. That Fed rate cut juiced the small caps. Like the Russell went nuts, and it should go nuts because higher interest rates are not good for small caps. Large caps can tolerate higher interest rates. Small caps can't because of the discounting mechanism and the borrowing mechanism. So the small caps got their juice, but somehow, Bridget, they've kind of like hit a wall. And just in the last month alone, like September is like the Fed comes in and says, we're going to cut rates. We get the rate cut, market's off to the races. The problem is it's been rescinded. The 50 basis point cuts already been taken away and then some. Right now, the long bond, the 30-year, has gone from a 3.7 handle up to a 4.5. That means three separate 25 basis point hikes have been reinstilled by the bond market. Now, careful, not the Fed, the bond market. And the
Right.
Fed can start to make its move if it wants to, but the bond market trumps the Fed. And those rising rates, okay, are putting a kibosh on the S&P. In other words, if the rates weren't to go up, we could see the S&P above 6,000. But the S&P's hit 58, not 5,900, Bridget, 8 straight days and can't break it because that interest rate is a prohibitive level and it's inflationary. And if you don't believe me, the housing stocks got dinged this week hard. Yesterday it was DR Horton. The day before was KB Homes. These home builders. Why are these stocks falling? Because mortgage rates are going up and the invest and home buyers are getting off the fence and backing away saying, we can't afford this right now. And that's the sign of an inflationary economy that's not going to necessarily it won't topple the market, but it will put a cap on it. That's what the market's telling you.
This is so interesting because a month ago, maybe 2 months ago, right after those Fed rate cuts came in, people were talking invest in housing. It's going to boom once these rate cuts come down. And this is kind of exactly the opposite of what many people were predicting, were expecting to see in the market right now. Um, what do you say to investors who were planning one way and now we're facing something very different?
Well, I would take it like this. You don't have to be all in. You don't have to sit there and tell me, I own 100% stocks, or I'm all in the S&P. It's an all or none game. You don't have to do that. You can take risk off the table and say, hey, look, I'm just going to put 1/3 of my money away. You know, it's okay to be wrong. Everybody's wrong. I'm wrong every day. It's just that's the nature of it. It's not being wrong that matters. It's how you manage your risk that matters. Okay. So the idea here for me is if you're thinking like, well, interest rates are going to go back down. They might just very well go back down and the Fed might instigate a rate cut. But you always have to approach the market as if you could be wrong. Think risk first, reward second, and the rest will take care of itself. I always put risk above reward only because if you can manage risk, you can survive forever. If you can't manage risk, you cannot survive forever. It's like the lifeblood of how the business runs. So if you're wrong on the way housing starts are, don't fret. A lot of people were. A lot of the analysts are wrong. My attitude is do some hedging. In other words, do some cross asset, tactical asset allocations. Move a little bit of money to bonds. Bonds have backed off. They become cheaper. The yields are higher. They're very competitive at 4.5% with the 2% on the S&P 500 dividend yield. Move a little bit of money to gold, even though gold's at a high, because gold may stay there for a while with uncertainty. Or if we're at worst case scenario, rotate your money and say, listen, I have most of my money in tech and financials and I've made a killing. That's fine. But maybe you move your money to some more defensive sectors like healthcare. So there's just different ways of approaching sector rotation and sector rotation from an asset allocation perspective as well.
I just heard you mention planning for uncertainty and risk, but we have a big shot of both of those things coming next week with the election. So I want to know, how could sector rotation come into play no matter who wins the election next week?
Well, if Trump wins, you know one thing, he's going to kick in the spending. So think about this. He's going to go after to build a wall down by Texas, construction, Home Depot, Lowe's, Caterpillar, Deere, heavy machinery, cyclicals in that sector. You're going to start to see a lot of contractual work be hired. There's Jacobs Engineering. There's all kinds of you know, construction service companies, large cap, mega caps. That's one area you should investigate if Trump wins because he's going to spend, and you know he's going to spend. The second is he's going to spend like crazy on defense. He is not going to let this war run amok. The Biden administration has cut back defense spending. He's going to ramp it up. So you might start looking at Raytheon, General Dynamics, Lockheed Martin, any one of these three stocks, mega caps, defense stocks, even cyberware, malware stocks. This is the place you'd want to be if Trump's going to win because he's going to pour money into those sectors. At the same time, if he does at some point not win and Kamala takes that reign and wins, you have to think about what she's trying to accomplish and what she wants. Effectively, what she wants is, she'll say, okay, we have to figure out new situations for immigrants. Well, if more immigrants are coming in, more health need for healthcare. That could be a surge in Humana, Cardinal Health, could be a surge in Merck, could be a surge in Lilly. All these companies that provide some sort of medical or service health plan to meet the needs of people who need it already and those new immigrants or people who migrate here into this country. That's an area that it is probably going to get a bump from. You might also get a bump from REITs. And you're like, well, why? Real estate investment trust. Remember, REITs, believe it or not, are the highest paying yielding asset class, not AT&T, not Dominion, not NextEra Energy, not the utilities. It's actually REITs that pay the highest. And if there is a fact that, she wants to make housable affording for everybody, what does that do? It sets REITs on fire because people are going to go after the home builders. They're going to go after being family homes, renting if they can't own. And that abets the REITs. It abets the home builders, right? So on that note, that helps Kamala Harris. So you can play both sides of the fence by sector rotating into things where Trump wins, or in the event he doesn't win, you can move to the other side of it. It's just spreading your risk and playing on what their agenda is.
I think that's the key points that you've hit on there. Is there's two possible outcomes. Anyone trying to plan their investments, even planning for risk, the uncertainty that's out there right now is so strong. How can you manage or plan for sector rotation and timing it well? Can you wait until after the election next week to really make a decision of where you want to rotate your own investments? Or are you better off to try and rotate maybe to both possible outcomes before the election starts?
Well, you could hedge your bet and both rotate to both. But I would more or less suggest this. There's an expression in the business that says, it's okay to be late. it's not okay to be too late. So if you don't quite hit the bottom on buying pharma, that's okay. You could wait till it starts to surge and pick up some momentum and start to wade in slowly. But don't wait until the last minute until it's run away 20 or 30%. You can kind of dollar cost average in. You put a little bit in here, wait a week. Outcome from the election comes out, it's uncertain. They got to count the votes. They put it on hold. Okay, it moves up a little bit. Add a little bit more. You don't have to do it. You don't. It's called chunking. You have to chunk it all in one time. You can raise cash, add a little here, rotate here and there, and do it progressively. You don't have to do it in one full-on shot. That would be the approach I would take.
While we're advocating for sector rotation in this discussion, but is there another strategy? And that is just to stay with some of those long and solid stocks. Maybe it's the tech giants that could still remain strong even through the sector rotation that might be coming. Is there a safe bet to maybe ignore sector rotation and just stick with some tried and true stocks that are out there?
I would say absolutely. You could just say, listen, I don't want to get involved and have to do due diligence and research and hem and haw and struggle over this and stay the course. But if you're going to stay that course, what I would say is make sure the companies that you happen to be invested in are well heeled, which means they're well capitalized, good cash flow, can pay you a stable dividend, are not as susceptible to the business cycle. So if somebody said to me, well, I own Starbucks, I don't see the point of getting out of Starbucks. I own McDonald's. Well, there's no reason to rotate. You got defensive plays that are in there. But you have to be able in this business, even to be an investor, to be a little bit flexible and sensible and say, listen, I think I'm overcapitalized or I'm overweighted in a lot of large cap tech. I don't necessarily want to sell Meta, Microsoft. I don't want to incur a tax cost. Okay, tax bill from the government. Got it. But cutting back and just scaling down the risk, not just as a form of profit taking, but raising cash to like take it back and prepare yourself for some type of maybe 10 or 15 or 20% plain vanilla every 4 year correction is never a bad thing. I've never ever said to a client, oh my God, you're raising cash? How ridiculous is that? Raising cash is always a good thing whenever things are overheated or at high. But raising cash when things are at a low, that makes no sense. That's where you put it to work. But at a high, it's okay to stay the course. Just don't stay too overweighted in those mega caps, the Googles, the Metas, the Microsofts. Keep them, hold them, but maybe take off 10 or 20%, put the cash away, and start to revisit maybe putting it back to them if it pulls back. And if not, might move it into bonds or crypto or gold, something of another nature where it's not as correlated. The word diversification is misused. People say, I own 500 stocks, I'm diversified. That's not what diversification means. Diversification is asset allocation via correlation. That's what it means. So you can't have it all in the same direction, no matter what product or assets you own. So having something that's not correlated to the S&P will actually offset and mitigate the risk in down times. And that's something you can't prepare for by the time of the day, but you can get ahead of the curve and say, listen, I know it's not expected, but it's never too early. That would be the approach I would take if I'd stay the course.
Well, some really good advice for investors out there who are looking at the uncertainty of the week ahead and are trying to figure out the best play for their investments. Thank you so much for walking us through some of these, Jeff.
Thank you for having me. It's a pleasure and an honor. Thank you.
Yes. And you can find many more market news stories talking about the economy, specific stocks, and much more market news right here on Market Beat Media. As always, thanks for joining us and happy investing.